All right, welcome everyone to our Klaas U webinar series. We're excited that you joined us today. This is our 2022 webinar series, and we got started back in February with our first one this year, and we've been doing them for the last few months, and we'll be continuing them into the fall. So first of all, I'd like to tell you, my name is Malia Cuevas. I'm a registered investment advisor here at Klaas Financial and also the CEO. I'm joined today with Josh Sterling. He's one of our portfolio managers on our investment team and also our guest speakers today from Asset Protection Services. Before we introduce today's guest speakers, however, we want to provide you a little background on our webinar series and the different types of topics that you might be interested in, which is part of our overall retirement planning as we work with clients. So back in February of this year, we covered investment planning and allocation. Josh was part of that webinar, really excellent for people to understand allocation strategies, especially during the climate that we all live in today. We also then went into estate planning in March, reminding our clients that having current estate planning documents is always a good thing for your future beneficiaries. Last month, we talked about mortgages, and of course, that's in the news a lot right now because we have rising interest rates, and people are really looking at that carefully as they look to purchase a new home or refinance. And then today, of course, we're dealing with insurance, more on the property casualty side, and I think you'll find a lot of great information from this today. Our webinars in the future are going to start back up in September. We're going to talk about Medicare supplements and what you need to do to plan for that. In October, we'll talk about our favorite topic of all times is taxes, and we'll have a CPA available. And then finally, November, we're going to talk about funeral planning because believe it or not, that's the only thing we can count on in life is that there will be a funeral someday. So we have an excellent speaker in line for that. So some background on Klaas Financial. We've been in business for 46 years. We started in 1976, and we've grown to over 20 employees with 2 offices, both in our Illinois and Madison area, here in Loves Park and Fitchburg, Wisconsin. We're a fee-only financial firm, fee planning. We now have serving over 1,000 households in 29 states. We are a registered investment advisory firm. We really spend time working with our clients with their cash flow, risk management, investments, of course, and overall retirement planning. So while we are actually insurance licensed, we don't offer insurance products to our clients. This is where we lean on some of what we refer to as our Klaas trusted partners. And today, the gentlemen that we're going to hear from are part of our trusted financial partner program. We like to lean on people that have expertise in all different areas. And we've had a very positive relationship over the years with Asset Protection. They have delivered great customer service, which is important to us as we direct our own clients to get assistance in these areas. And they've also provided good conversation on the type of coverages that you should make sure that you have in place. Hence, we felt like that would be a good reason to bring them on board today to review insurance coverages in all these different areas. So with that, I'd like to introduce Mr. Tom Olson and Bryce Davis from Asset Protection Assurance and let them get started with their program. So welcome, gentlemen.
Thank you for having us. Thank you for the wonderful introduction, and we're excited to be here and see how we can help clients ask or answer any general questions and more or less take the lid off of insurance so everybody feels comfortable. We are a local independent insurance agency. We've been in business since 2009. Before 2009, Tom and I both worked for MetLife Auto and Home. And so that means that we worked for just one company only. Within the first year to 6 months, it was very apparent that people change, the companies change, ages and stages keep changing. Whether you're just beginning to have children or grandchildren, every carrier will kind of fit into a different niche in regards to what products or what markets that they target in that regard. And so within roughly about a year for being at MetLife Auto and Home, Tom and I decided to go out on our own and become an independent agency. And so now we write for a number of companies. And we're able to help our clients more broadly in regards to the unique changes and needs that they go through over time. Again, I'm Bryce Davis. I specialize in business insurance, commercial lines, your general liability, workers' comp, commercial property, commercial auto, whereas Tom Olson specializes in personal lines products, protecting your family, autos, homes, investment property, so on and so forth. We are located in Loves Park here locally, Northern Illinois. We're licensed in Illinois, Wisconsin, North Carolina, Arizona, Tennessee, Florida, Ohio, and Texas. And so generally speaking, we've got, I guess, a wide base here in Illinois, but we do branch out to other states as well, depending on the needs of our clients and where we're at the time. So I suppose what I'll do is I'll get started by just handing it off to Tom Olson to start off with the first general question that we have from the group, which is my home insured properly?
So a lot of misinformation's out there. What your home insured for is not what you can sell it for. It's not what the market is demanding or anything like that. What we insure for is replacement cost. There are policies out there that do actual cash value. Our agency, we do not do that because it's not adequately providing the protection that our clients deserve and need. So what that does is we look at, there's metrics to that. You put in the property characteristics and it comes back at what it would cost to replace this house if it was a total loss. Whether you're a fire or tornado or something like that, we insure it for board, nail for nail, replacing it and debris removal to make it back as it was prior to the event. So that's a big hurdle to get over. People will say, well, I can't sell it for that. It has nothing to do with real estate or what the market offers for what would be sale or worth at the time. A big thing another people ask is how much liability do I need? It doesn't cost a lot of money to put you into the proper liability for your home. We do see people come in with low limits and we correct that for a few dollars more and explain to them exactly what that does. It's to protect you from lawsuits, injuries, those kinds of things. So we recommend a minimum of $500,000 on the home. There are other caveats you can put on these as far as what's called endorsements. Some of the biggest ones are the backup of water and sewer is a common endorsement. Umbrellas are very common to get as well. On top of that, to blanket over the auto and home. However, flood is not covered. That's a separate policy. Earthquake can be endorsed, but it's not very common here. But those are some of the quick rundowns of what a house should be properly insured for it. And then each carrier has its own little caveat on how you can customize it depending on your risk and your comfort levels. We do suggest a minimum $1,000 deductible for a few reasons. One, would you really turn in a claim anything less than that? And then you are subject to anytime there's a claim to have your rates adjusted. So that's why we like to keep the risk threshold at $1,000. You can go up. Some people are more comfortable with that. That's fine. But we really don't like to go below that. It's to save money and you're just taking on a little bit of the risk. Medical payments too. Some people, you don't want to keep it too low because that is subject to deductible. If you have $1,000 deductible, $1,000 medical payments, virtually you have none. So a minimum there, we like to keep at $5,000 as well. And here again, one big thing to note is if anybody has any actual cash value rider on their policy, be very leery about that because you won't find out exactly what that does until the event of a claim. So what would happen is you would lose, if you have a loss, you're not going to get replacement costs, you're going to get actual cash value plus depreciation. So you're going to walk away owing to get the house repaired. That's a very big thing. So I don't know if there's any other questions. I know it's a quick overview, but.
Yeah. And so what we've done is more or less we've taken a summary of what your typical insurance policy will look like. Regardless of the carrier, you're going to have the dwelling amount, what it's insured for. And then every limit that falls below the dwelling is a percentage, or we'll call it factor, of that dwelling amount. And so what you'll notice is the next limit, other structures, that's going to be anything that's not attached to the home. So if you've got any outside garages that aren't attached to the home, fences, gazebos, those sorts of items in the yard, pools, literally any other structures that aren't attached to the home will typically be about 10%, or depending on the carrier, up to 20% of the dwelling amount. Moving down to your personal contents or your personal property, the best way we can describe this coverage is as, take the roof off the home, turn it upside down. Anything that falls out is going to be considered your personal contents. And most carriers are going to set that limit to about 75% of the dwelling amount. And then we've got your loss of use listed next. This is going to be, Lord forbid, I can't live in my home. Where can I go to find a home like quality and kind? And if that's the case, again, depending on the policy form, they're either going to give you a time limit or they're going to give you a dollar amount, literally a percentage off the dwelling again there as well. What you'll notice, I guess piggybacking off Tom's description of deductibles, you'll typically have a $1,000 deductible or a flat deductible. What we have seen is some carriers will take a percentage of the dwelling as the deductible if there's prior losses. I won't name companies, but what they'll do is they'll put a 1 or 2% percentage deductible on that home. And so in this case, if you weren't aware that you had a 1% wind hail deductible, you might be looking at a $7,477, roughly a $75,000 or $7,500 deductible. If it's 2%, then you're looking at a $15,000 deductible. And so those are some things to be keen on. That way you're not caught in the surprise in the event of a claim. And then lastly, just to touch on again, the home and any property for that matter should be insured at the replacement cost. So that's literally the replacement cost minus depreciation is your actual cash value. So we don't want the materials depreciated by any means. And so what that means is because the cost of materials do increase each year, what homeowners will realize is that the cost to insure their home quite naturally should go up a little bit each year to keep in line with inflation and the rising cost of your home, especially in an environment that we're in right now, where inflation doesn't appear to be as transitory as we've been told. So in that regard, it would be a good idea to review the building coverage or your dwelling coverage on your home to make sure that it is adequate. I heard an interesting stat that the cost of homes have gone up. I think it was around $52,000 for the average homeowner across America, which is, basically just in line with the average wage of people in America as well. So that's just quite a staggering statistic to where if the cost or the value of a home has gone up, that's one factor, but what we're looking at is the replacement cost of that home. And so with building materials going up, it would be a good idea to make sure that your home is insured to value and that the inflation index on your home isn't set too low with this environment.
Bryce, I just want to mention, so if people have questions, they can submit them on the Q&A button on their screen, and we'll be addressing those. I have a question for you, though. I'm seeing your notation there about theft limitation on jewelry and so forth. Could you just speak to people that should have maybe some of their personal property scheduled with regards to things that might not be covered unless they are scheduled?
Sure. So under your personal property amount, that's things that are covered that are common in everybody's household. When you get into higher ticket items, a piece of jewelry, a Rolex watch, earrings, those kinds of things, what we like to do is schedule those. And there's many reasons why. The first reason to schedule those is you're covered for more than just theft, because as your policy comes out, there's a limitation and it's only for theft of what's common is $1,500 per piece with like a $3,000 max. So if you schedule it, you can get it for agreed value, zero deductible, and mysterious disappearance is even included. So it's an all risk. So it's not only just theft, it's for, you're out skiing or boating, whatever, you take off a glove, whatever it might be, and the item goes flying, or you leave it at a restaurant to clean up, whatever. That's called mysterious disappearance. That will be covered, no deductible for the agreed value, which is determined by your appraisal. So you can do that with collectibles, high-end bikes, things that aren't common in everybody's house. Jewelry is the big one. Furs and art are your top three.
And they would submit appraisals and so forth, I assume?
Correct.
Correct. Tom, have you ever had a client lose any jewelry, a boating accident, or any situation like
Yes,
that?
we have. We've dealt with that. We had some clients out on their boat on Lake Michigan, and they somehow ran it aground, and they had quite a bit of jewelry on them, and mysteriously it was all lost. The claim was covered fully, but it was pretty sizable one, and I raised my eyebrow a little bit, but I don't know who goes out with $300,000 worth of jewelry out boating, but
it's covered.
But it
if
was
you
covered.
schedule it.
They would have only have gotten $3,000. Instead, they got $300,000.
Wow.
Yeah.
Good to know.
Hey, Bryce, I actually had a quick question as well, if you don't mind.
Sure.
You were talking about inflation, and as the investment person here, I was wondering, how do you account for that in getting your home properly insured? Like, are you supposed to be reappraising your insurance every single year? How often should you be looking at that with kind of inflation and home prices going up?
I would say certainly they're going to have an inflation index or inflation factor, cost of construction index, kind of the same terminology, but that's going to be anywhere from 2 to 6% in a typical environment. But when we move into environments that we've been getting right now with this consumer price index printing, well above 8 and 7%, this would be kind of the alarm bells to say, hey, we should probably review that. And so what we do is we'll rerun the replacement cost calculation, year over year. That way we know that the home is insured to value. Whereas, yes, you can kind of passively let it manage itself with a 2 or 6% index. However, you can get in a situation where you're getting behind the curve when you do have, large inflation numbers year over year in that respect. And the same token, if you set the inflation index too high, or your home is insured for a higher value, then you can easily get it overinsured as well. So it is somewhat of a nuance, but I would say it would be a good idea to review it, if not every year, every other year, to make sure that it is, again, in line with the replacement cost, not the market value. It's almost certainly in Illinois local market, the market value is always going to be less. When we get out in Arizona and there's not foundations and the heavier costs of construction associated with that home, they definitely come down more in line with the market value. But there again, it's unique to each situation and I guess domain, if that answers your question.
Yeah, I know up here in our Madison market, it has been a very hot market, and home prices have been going very, very high for years and years and years. So that's helpful.
Yes, and even the labor market in Madison is extremely difficult right now. It's hard to get help, and so you're seeing the cost of construction rise just because of the labor shortages as well. And so I guess we'll get on to now. What is our risk with a contract with insurance? We'll pay our premium. That's the first portion. The insured will trade their premium in turn for coverage. And then if there's a loss, we'll assume the first, or I guess $1,000 with $1,000 deductible, $1,000 of that risk. And so what deductible should I carry? Every insurance is different because, again, it comes down to your risk appetite or your risk preference, along with your time horizon. And so there's a few different ways, but first and foremost, I would always recommend having an all peril deductible, a flat deductible. As I touched on earlier, depending on the carrier or the agent, they will use percent deductibles. There again, where it's a percentage of the building cost as a deductible, not a percentage of the loss. Often we find people will misinterpret that for a percentage of the loss that they're paying. It's a percentage of the dwelling coverage on the home. And so what you can find is, if you're not careful, you have a rising cost of your home, and then you've got a rising deductible in line with that. And so, as we mentioned earlier, quite naturally, the cost of your home to insure should go up each year in an inflationary environment. But what you wouldn't want to see is your deductibles also going up as well, because then you're essentially assuming more risk as time goes on. But if you did want to, see what makes sense in regards to what deductible you should have, or if you're considering an increase, it's a very simple formula. You just look at the difference in deductible relative to the difference in premium. And so we'll assume in this example, we've got somebody with a $500 deductible. They're considering moving up to $1,000 deductible. Does it make sense? Does it not? So what we would do is just take the marginal difference in deductible, and then we would just divide that by the difference in premium. And so in this example, we've had Tom quote the difference for us, and it's about $125 difference to increase, or $125 savings to increase to $1,000 deductible, i.e. the $500 difference. And so with this example, what you'd see is you will gain about $125 a year, but let's keep in mind, this is going to be after you reach the marginal difference in premium. So after about 4 years, you would then start to recoup the difference, whereas you'd be paying that $1,000 out of pocket. When I say out of pocket, it's not necessarily out of pocket. If there is we'll call it a $100,000 claim, the adjuster will most likely cut you a check for $99,000. In this example, again, less the $1,000 deductible. And so you don't have to pay out, but more or less you will absorb that risk premium, or that deductible, excuse me. And as we segue to auto.
Sure. So on auto, here again, what we're starting to see is some people, the best way to describe this is what we want to start seeing is the 250 to 500,000, 250,000 for property damage. This not only protects your exposure, but if somebody with state minimums was to be involved in an accident with you and don't have adequate coverage, you would be on the hook for that, because their policy is going to cap out, and then you're on the hook for the rest. Okay, so you want to keep, what we're starting to see is market trends that are starting to go to this 250, 500, 250. And what those mean is if you're in an accident, you hurt somebody, we're going to pay $250,000 per person and $500,000 per occurrence. So if there's one person in the car, you have a medical for that person, prevent lawsuits for $250,000, $500,000 per occurrence. Same thing with underinsured and underinsured. That's for you. If somebody hits you and doesn't have the proper coverages or no coverage, you get the $250,000. If you're by yourself, $500,000 per occurrence. So we all know with the rise in everything else, including medical costs, which skyrocket, heaven forbid you need a helicopter or something like that. This is where this would pick up. So it's to protect you and to protect lawsuits from others. Same thing on the property damage. With the price, I don't know if anybody's been shopping cars or anything, but you can see the prices of the cars are going up. So whatever you damage with your vehicle, that's what our limits are going to be. So if you have multiple cars, objects, anything from the state or anything, or you run a semi off the road, those things you're going to be responsible for all that, even the contents of what that semi was hauling. So there is the risk there. So that's why we're starting to, everybody's starting to move up to these limits here. Here again, the deductibles, you don't save a ton raising your comp deductible, which comp is fire, theft, wind, hail, a tree falls on your car, you hit a dog, a deer, something like that. Those are comp claims. What drives your premium mostly is going to be the deductible you carry on your collision. That's how much you're self-insuring your vehicle for. So if you get an accident, your damage on your car is $10,000, you're going to get a check for $9,500. Another thing to consider would be loss of use, rental car coverage. So here again, these people hit you, they don't have any insurance, you're stuck for the rental car. If the accident's your fault, if you don't have a rental car, it's on you. If you have that coverage, you're going to get a rental car either way. You should keep your medical payments as high as possible, especially if you don't have any health insurance or high deductibles along those lines. This even covers if you're a pedestrian and get hit. A lot of people aren't aware of that. So, and again, just to reiterate here, the state minimum in Illinois is $25,000 per person, $50,000 per occurrence, very low, and $20,000 for property damage. It's not adequate. They're just trying to get you to get something in Wisconsin, and it's much better. It's at 100, 300, and 50,000. So that's their state minimum. So here again, your exposures, we know that. Just driving down the road, but you are responsible for anything you caused. If you hit a school bus or any cars and they spill fuel into the ground, well, now we've got an EPA issue. There's a lot of things to think about other than just premiums. What is my exposure? So all this comes down to, what is my exposure? What is the risk? But that's where we're starting to see things go. This is what we'd consider properly insured. And it also is the minimum for most carriers to qualify for an umbrella. So to get an umbrella, you have to have underlying limits that meet certain standards for underwriting. to qualify for the umbrella, which is an underlying policy which covers all over the auto and home under your liability portion.
Yes. And so not to be redundant, but as Tom touched on, your liability is going to be a third-party coverage. If you hit some black ice and follow someone too closely, if you hurt or injure them, your policy is going to pay up to $250,000 for that individual that is injured in that accident. On the same note, you've got medical payments. That's going to be a first-party coverage. That's going to be designed for yourself. If you don't have any health insurance and you're injured in an auto accident, this is your only form of health insurance. And so if that is the case, or if anybody has that situation, whether it's their children or maybe in between transitioning jobs, you would want to, at least at some point, review that medical payments to make sure you've got enough coverage for health insurance. We've also seen increased costs of health coverage. So we've got higher deductibles, higher max out of pockets. There used to be a day where $5,000 would cover your deductible and your max out of pocket. Not necessarily anymore. So individuals may want to review their medical payments on their auto policy just to make sure that it's going to cover any sort of out-of-pocket costs that are associated with your health insurance. Again, your health insurance would kick in, but you'd be subject to your deductible. And if you're injured in an auto accident, medical payments would pick that up.
Just to touch on one last thing, a lot of people think that when they see these limits, that's all they're responsible for. That's not true. These limits get exhausted. The first thing these attorneys do when you see them on TV every night is they discover assets. So they're going to start looking at what you have and what they can liquidate and what they can get. So this is some of the best protection you can get.
Yep. And so that would be a good time for us to transition into an umbrella policy. What is an umbrella?
Can I stop you for just a second,
Sure.
Bryce? Can you just quickly explain the difference for our listeners between comprehensive and collision? And because people are keeping their cars longer, when does it make sense to start dropping one of those coverages?
Certainly. So the best way I can describe collision coverage covers two things. If we hit a fixed object or another vehicle, everything else is going to be comprehensive, as Tom mentioned. Animal eats out your wires of your car, tree falls on it, neighborhood kid hits the ball into the windshield, fire, theft, vandalism, all of those, everything other than a fixed object or another vehicle. And again, as Tom mentioned, as far as if you were to look at the itemized premium for comprehensive coverage, the itemized premium's anywhere from a quarter or a third of the cost of collision, but it covers much more exposures. And so if you're controlling the things you can control, it's going to be collision, fixed object or another vehicle, but things outside of your control, again, tree falls on your vehicle. It's really not an expensive coverage. And so a lot of times insureds will say, I want to go down to liability only, I want to save money. Well, that's fine. I understand that. If you want to remove the collision coverage, in case you hit a fixed object or another vehicle, I understand, but you may want to consider liability plus comprehensive only. Because it's really, the comprehensive coverage isn't very absorbent in regards to having that added protection of not carrying collision coverage, but still, if you hit a deer, those are things that necessarily you can control. And so that's always an option. And so and without an itemized declaration page, it's a little bit more difficult. But what we would do here is if our car is getting to the point where it's reaching a salvage or residual value to where we don't see much value in it anymore, then let's look at the collision premium and see how much that costs. And then we can start to back out, what's the time horizon in regards to the salvage value divided by the itemized premium. So if we've got, a car that's only worth $1,000, but we're paying $250 or $300 a year for collision coverage only. Well, then, how many years would it take? Around 3 years to where if you had a claim, would it make sense to even utilize that coverage? At some point, it just wouldn't be because, well, you will, as much as people like to believe Illinois is a not at fault state, it's not. Anytime the insurance company pays out for a claim, unless you have accident forgiveness or an additional rider on your policy, they won't operate at a loss. Your premiums will get adjusted in line with the payouts that they've had. And so I guess what I'm trying to say is most likely you'll have a rate increase with any sort of activity. And so, as you had mentioned, Malia, at some point it does make sense to just consider maybe dropping collision coverage. Again, we would also advise you to consider keeping comprehensive coverage on depending on the value of the vehicle.
Rule of thumb, Alina, is when you start looking is 10 years. That's the long and short of it. 10 years, you want to start looking and see if it makes sense to start going to liability. Here again, we like to see people keep comp on there because, a rock hits your windshield, covers your glass, those kinds of things. So, and it's not much to keep on the comprehensive. It's the collision that drives it. But at 10 years, you want to start looking. Vehicle hits 10 years old based on its condition, mileage, those kinds of things.
Great, thank you.
And so, as we transition into umbrella, anything under the umbrella doesn't get hit by the rain, or it shouldn't, unless we've got some side winds, but not to get off track. So what we've got, the best way I can describe it is you've got your auto liability and your home liability. Your umbrella is going to protect everything above and beyond that. So if we've got $500,000 of liability coverage on our home and $500,000 of coverage on our auto, and we have $1 million umbrella, you'd be looking at effectively, $1.5 million of coverage for each policy when added together. And so, do I need an umbrella? I would say there's a lot of situations, most that people are aware of, that it would make sense for you to have an umbrella. Some examples that I have here are, I've got a teen driver, I've got a 16-year-old on the policy. You certainly want to consider having an umbrella when you've got a vehicle titled in your name with an inexperienced driver. That's definitely a cause for concern, where if they do, again, just based on their experience, get into a terrible accident, if that car's titled in your name, it's certainly going to follow you. And so you'd want to consider an umbrella, at least review an umbrella whenever you're adding a teen driver. Another example would be is if somebody slips, trips, or falls. That's, believe it or not, it's one of the most common claims we do see. And so you'd want to have an umbrella for that sort of exposure. If you've got pets in the family, any sort of pet with a bite history, certainly I would consider an umbrella. Your dog is a liability. He's our best friend, but he's also a liability if he is hurting or if somebody's bitten, injured, especially if there's any ongoing or lingering injury where there's permanent or partial disability from that bite. And then common liability exposures that all insurance companies will underwrite. Pools or trampolines. Those are also going to open up exposures to where you might have a claim for liability where you'd want to consider having an umbrella. What are some umbrella exposures? Attorney's fees, loss of wages, medical bills, pain and suffering. If somebody is, again, seriously injured where there is a permanent, partial, ongoing disability, then they may need home modifications. And so with liabilities, there can be almost no ceiling on how much those will pay. And so the best way we can kind of characterize that is you always want to make sure you've got, it's a kind of like how a balance sheet formula makes out. Your assets, you should have liability protection to cover any assets or equity that you do have in the home, or any assets that you have, because all of those are potentially at risk. So any investments that you may have, home equity, checking, savings, the investment returns that they've gained through Klaas Financial, and then of course any futures earnings or wages, depending on who's hurt, whether it's lawyer or doctor, they do command a higher wage. And so if you're paying for somebody's lost wages due to an accident, injury, then you'd want to certainly make sure you have enough liability protection there. And so again, the examples are your auto liability protection, your home liability protection. If you've got any recreational vehicles, watercrafts, boats, your umbrella will also, again, act as an umbrella and cover those policies as well. And so I guess a rule of thumb to look at, do I need an umbrella? I would add up all of your liquid and I guess non-liquid assets that you do have. Again, how much is equity in your home, your wages, how much money do you have saved in pensions, retirement accounts? And if that number is higher than your liability protection, if that's higher than $500,000, then you should certainly consider an umbrella. And you'd certainly want to get quoted on a 1 to C, because whatever that difference is, if you've got a $1.5 million in assets and you only have $500,000 in coverage on your home, once your liability protection on your auto or home is exhausted, any savvy attorney is going after that extra $1 million sitting out there.
And they're affordable. It's not an expensive
and they are affordable. They're, really, I would say, depending on what you put on your pizza, $20 to $25 a month, price of a pizza a month.
Mhm.
So what do you, may I ask, do you have different amounts of umbrella policies, a 1 million and a 2 million or something like that?
Yep, we'll generally just run it in $1 million layers.
Mhm.
And so depending on whatever the premium is, you might be looking at $200 per $1 million layer or $250 per $1 million layer. Again, the insurance company is going to underwrite for the exposures there. So if you have teen drivers on the policy, it's going to be more expensive to have that umbrella than if you don't have teen drivers on the policy. But that being said, you would want to consider that. Taking it a step further, as Tom mentioned, you've got state minimum limits out there with some drivers. And so what happens when I'm injured so bad by somebody that doesn't have adequate protection? They've got 25,000 per occurrence or per person, and I'm hurt. Well, you can endorse your umbrella policy to pick up coverage for uninsured and underinsured motorists bodily injury as well. And so if you're hit by an uninsured or underinsured motorist and you have an umbrella, this could act as a way to basically cover that gap of somebody else that didn't have the exposure or didn't have the adequate coverage that they needed, or yours is exhausted.
Mhm.
So moving on, business insurance, it's such a broad topic that I didn't want to go too granular. And the best way I can kind of describe your business insurance is there's a million ways to make money. And so you're going to have much different coverage if you run an oil refinery than you are if you run a library or an office or a bakery. So I would say when it comes to business insurance, there should be a risk assessment needs, and it should be reviewed for the specific risk that it is. As much as people would like to think, there are no two same financial services companies. There are no two bakeries, whether it's the equipment, the employees, the payroll, the sales. There's so many different dynamics that one would have to look into to make sure that not only is their property covered, their employees are covered, their loss of wages or loss of business income is covered, along with any property or equipment they have, whether it's mobile or not. And so when it comes to business insurance, I would certainly recommend having an independent insurance agency because they're going to be able to look at several different companies, again, through different stages and business environments and climates that are cyclical with business, depending on the season or not. But that's the starting point for business insurance is you want to make sure you've got an agent that isn't confined to one carrier, one solution as an option. And if to look back at how insurance has evolved over the last, I would say, a few hundred years, businesses have almost always entirely operated off of an independent agency distribution model where, you do see insurance for their auto and home, maybe not necessarily see the value there. But I would say it's almost a certainty when it comes to business insurance that you should be getting, you should be able to have access to markets or carriers that specialize in coverage for your business. And that is more or less, a summary of the questions that were presented that we wanted to address and see if we could help your clients, without reading front to back of the insurance policy, have a better understanding of some of the risks and coverage that they may need or should consider.
There's just so many options that you can customize for everybody, but it's paramount not to be stuck to one carrier because now you're trying to make everybody fit into the mold of that one carrier. You got to have options like the Hartford kind of, they like the older drivers. They're not so much with the teen drivers. Then you got other carriers that we love teens and we give you accident forgiveness. But so to be stuck with one carrier and you haven't looked for a while, do yourself a favor and at least check. That's why there's so many insurance companies out there. It's everybody's offering a different thing for a different niche.
And they also have different underwriting cycles when they tighten or increase their rates in order to become profitable. They all do it at different times. And so what you'll find is some companies decide to take rate in January, where the other rate company might not start to take rate until July. And so when those renewals start to generate, it's a very dynamic process. It's not it's not so cut and dry, I guess we'll call it.
Correct.
Is there any questions that have came up that we can help address, or if anyways we could dive deeper in any topics?
I guess we can ask a few questions here. If anybody has any questions, like Malia mentioned earlier, feel free to go to the Q&A button below and type those in. We can answer any questions. We have about 5 to 10 minutes available for that. But we did have one question pop through. At what age should I have my kids get their own policy?
Add your child to the policy? Once
Or
they have
getting their own policy?
Have them get their own policy. This is a good one for you.
Okay, so there's underwriting guidelines for that. Is the vehicle titled in their name? If they're living in the home, they're supposed to be listed on the policy, especially if the vehicle is titled in your name, it has to be on their own. However, if that vehicle is going to be in their name and they're okay with being excluded from driving your cars, you can pull the trigger and put them on their own when they're licensed.
And it's what you'll find, though, it's not very cost effective for an inexperienced driver that might not have an established credit discount, an auto home discount. There's just there's several discounts that mom or dad will have that the children won't be able to have until they're around 24 and 25. And coincidentally, that's when the premium does start to come back down within a reasonable range where, from 16 to 23, 24, it is quite absorbent for inexperienced drivers.
It is a common question, though, but in the event of a loss, they're going to look and see who that vehicle is titled to. So if that vehicle is not titled to them, there's no way of doing that. So the vehicle would have to, first you'd have to title it into their name. Then you have to weigh the options because, like Bryce said, you're going to lose the marriage discount, multi-policy discount, multi-vehicle discount. There's so many discounts because parents will want to do that, thinking they're distancing themselves from any exposures. But then the vehicle still titled in their name. We can't do it. And if they're still living in the house, they're still going to come for everything in the event of a loss. And it's just not cost effective 9 times out of 10 because they're going to pay the policy for Junior going out on his own. It's going to be substantially more than keeping him on the policy.
Good question.
Well, I had a quick question then. I guess in general, what's the most common gap in insurance that you see people have that come in and kind of get reviewed?
Liability limits.
Yeah.
The low liability limits is the most common gap. Even looking at, because on your homeowner's policy, typically the liability is going to max at $500,000. There are some carriers that will go up to $1 million, but generally speaking, even with the example that I've got here, you've got a home valued at $750,000 with $500,000 of liability. Assuming that home's paid off, which Malia and Klaas Financial are going to make sure that they help you do. You're going to want to consider some liability protection, and that's the most common one. We'll see $100,000 liability limits with $1,000 in med pay, and it just doesn't. For the $13 a year savings or something, we'll call it nominal. It's kind of more or less, it's our founding principles. It's asset protection insurance. So the first thing we do is we always address the liability concerns.
Because we've seen it used. I have a client on my desk right now, the high-end home, and they have $100,000 in their liability. And I just look at that and shake my head like, what kind of agent did this to you? Because you don't even, first of all, they don't understand what they're buying. And the second thing is they're so exposed now, they just don't even understand the risk. And they even have a teen driver on their car. It's like for the extra $10, $15 a year, this guy was trying to, sell you on rate. We're more about value, and we want to sleep at night. We want you to be able to sleep at night. If anything happens, we don't have to worry about it. So those things, the low limits and the underinsured value of homes is what we see.
Number
very
2
common.
is the value of the home.
Underinsured homes is the second biggest thing.
One question I have, which I have many clients who've asked this question, is I'm on vacation and I'm renting a car, and they want to sell me the insurance there at the rental car place. If I have an insurance policy for my cars at home, is that good enough, or should I always add on the additional coverage at the rental car place?
So the home won't play any role in that. So it'd be on your auto policy.
Mhm.
It is continental United States. So if you go outside of that, you definitely want to purchase theirs. Yes, you definitely would want to check with your carrier. The companies we represent, it all would extend to that.
Mhm.
The other key thing is to make sure your policy has rental car loss of use. So what that does is you damage this vehicle, it's in the shop for a week. The rental car company is going to come back after you and say, listen, we get $300 a week to rent that car. Insurance isn't paying for that. They're just paying for the damages. You owe us that $300. Or if it's 2 weeks or a month, you will be out that. So most of our carriers do offer rental car loss of use. It's a nominal fee. So if you're out doing that, yeah, you don't have to take theirs. You damage it, they're going to pay for that loss of use. They're going to pay for the damages. It is subject to your policy deductible, and it is subject to surcharge, just so you know. But yes, you do not have to take theirs.
It is covered. The only thing that's not covered is the loss of business income from that rental car company.
Okay, great.
All right, taking a look at the questions and answers, looks like that's all of them that we have for now.
Okay.
Well, thank you so much for having us. If there's any further questions afterward, feel free to direct them to our agency. You've got both of our emails listed here on the screen. And of course, our contact information. Feel free to contact any of us directly or our office in general if there's any way we can help with your insurance needs.
Great. And I would just add here today, I think the message that asset protection has given us truly is that, we want to be not underinsured. Many times we hear our clients talk about how expensive, with inflation, of course, but everything, especially insurance premiums. So we don't want to be underinsured for sure. We don't want to be overinsured. We want to be adequately insured. So we do suggest to our clients to shop their insurance every couple of years. Go to an independent like you can offer, so that you can price it out for them and check those coverages, because ultimately protecting your assets, I don't know why we spend so much time every day, Josh and I and the rest of our team, trying to grow your assets if we're being short-sighted and not covering your exposure like these gentlemen spoke of today. So really appreciate the knowledge you shared with us today, and hopefully everybody took some notes and at least takes a look at their deck page tonight. So thank you very much for all of you participating tonight. Have a wonderful evening.
Yes,
Thank you
for
very
the
much.
opportunity.
Bye-bye.
Bye-bye.